Okay, all right, class number 5. So we're going to skip that. We're going to go right for stock compensation. Okay? So we're going to start with the basics of stock compensation. So we're not going to talk about tax accounting first. We're just going to talk about what are these awards, how are they taxed. Okay? So anytime we talk about stock compensation, we're going to talk about what it means to the employee, what it means to the employer. Okay? So make sure you get straight in your head whether we're talking about employee tax consequences or employer. Okay? Ultimately, when we do our tax accounting, our tax provisions, we're only going to care about the employer taxes, right? Because we're doing the tax accounting from an employer perspective, of course. But I want you to have both sides of the equation just so you can kind of get straight in your head how things are working. Okay, so options. There's two kinds of options. There are NSOs and there's ISOs. Okay, ISOs are incentive stock options. NSOs are options that are not incentive stock options. Okay, so some people refer to ISOs as statutory options. The reason they say that is because statutory options are provided for in the code. If you look in like section 421, that's what deals with incentive stock options. And if you have a stock option that is not defined by section 421, then it is a non-qualified stock option. Okay? So in general, if you polled Silicon Valley companies and you asked, what do you grant? Do you grant ISOs or do you grant NSOs? The answer is NSOs. Okay? The kind of 1-minute version of why that is because ISOs seem like a great thing, but as we'll talk about it in a minute when we talk about the tax consequences, there's a little bit of a downside risk with ISOs, and a lot of employees suffered that downside exposure when the dot-com bubble burst back in like 02, 03. And so companies don't like their employees getting hurt by the things they try to think are good things. So even though the company was trying to do a nice thing, try to compensate you, try to give you good tax advantage by giving you these types of awards, it actually hurt employees because things went south on them. So most companies don't give ISOs for that reason. It's just too complicated, and especially for mature public companies, you rarely see ISOs, almost never. Okay? So the major difference between ISOs and NSOs is for ISOs. So if you're a holder of an ISO, so let's say that Cindy works for Oracle. Oracle says our stock today is $25. I don't know what your stock is, but let's say it's around $25. And they say, look, Cindy, if you work here another year, we'll let you acquire our stock for $25 then, if you want. And so let's say a year goes by and the stock went to $26. Okay, the stock went up $1. So Cindy would say, hey, I would like to buy a share of stock for $25 because it's $1 in the money. That seems like an economically smart thing to do, right? So Cindy can do one of two things. She can either take that stock that she got, right, because she's going to cut a check for $25, and she's going to pay Oracle, and they're going to give her a share of stock that's worth $26, right? So she has $1 of unrealized gain. So she can do one of two things. She can either sell the stock, or she can hold on to the stock, right? Okay, so if she sells the stock, that $1 is wage income. Okay, it looks just like cash compensation. It goes in her W-2, it's taxed at ordinary rates, it looks just like cash compensation. Okay? But she gets $1 of income, and that seems like a good thing, right? So that's what's called a disqualifying disposition, and the reason is she didn't meet the holding period requirements. Okay? So I'll come back to that in a second. Let's say she holds on to the stock. If she holds on to it for at least a year, then that means that she held on for a year since she bought the stock, since she paid the $25, and 2 years since the option was originally granted to her. Okay? So those are the holding period requirements for incentive stock options. You have to hold the shares 2 years from grant and 1 year from exercise. And if she holds that stock for a year, and so she meets those holding period requirements, let's say the stock is still 26 bucks in another year. Then that dollar, let's say she sells the stock the next day, that dollar of gain, that's no longer taxed as wage income. It's taxed as a capital gain. Okay? And so Cindy's in a super high tax bracket, and so having income taxed at a capital gains rate is a good thing because the capital gains rate is lower. Right? So Cindy might say, man, I really want to hold that stock that extra period of time because I want that dollar to be taxed at the lower tax rate. Okay? That's what that incentive part of the stock option is. It's the, if you hold on long enough and you kind of act like an investor for a period of time, then the tax code treats you as an investor and gives you capital gains. So even though the reason you got the option was for employment and services and that sort of thing, because you met that holding period requirement, it's taxed like a capital gain. Okay? So the problem is that in the year that Cindy exercised the option, in that example, she didn't have any income, right? There was no gain. There was no gain until she sells the stock. But there's a rule that says for AMT purposes, she picks up that dollar of gain. Okay? So a lot of people pay AMT in California because of how high state income taxes are, how high state property taxes are. And so if you on your tax return have to pick up that dollar as AMT income, that's kind of a bummer. You probably have to pay tax. I mean, it depends on your personal tax situation. But there is an issue with, in year one, meaning the year that you exercise the award, you have to pick up a small AMT pickup. Okay? And so for somebody who's not paying AMT, that person doesn't care. But if you're paying AMT, picking up that dollar is not fun. Right? And the risk is, let's say that she exercises when she's a dollar in the money. She picks up that dollar of AMT income. And then let's say the stock goes to 18. Right? So now she picked up a dollar of income for AMT purposes, but then she ultimately has a capital loss on the transaction. Okay? You don't want to do that. That is not good personal tax planning. Okay? And so that is the problem with ISOs. Okay? So folks were kind of going for that capital gains tax answer because they're like, stock's going to go up, I'm going to hold, I'm going to pay less tax, this is going to be great. And then when the market collapsed, everyone's like, this is not good. I've already paid tax on this gain, but now I don't only have a gain, and I can't get like an AMT refund, so I just paid tax on gains I never even realized. And a lot of people were picking up large AMT amounts, and then the stock went to like 0. So they're like, I don't even have the money to pay the AMT. I'd like to pay the AMT, but I can't, and so it's a huge problem. So that was one of the fallouts from the whole dot-com bust. And then companies said, man, these ISOs, this is not good, right? This is causing a lot of problems for people. And so that's one of the reasons you rarely see those anymore. Okay? The key takeaways are, if you have an ISO, you either meet the holding period requirements or you don't. Okay? If as an employee, so we're talking about the individual side now. If you don't meet the employment or holding period requirements, it's taxed as wage income, which means the corporation gets a wage deduction. If you do meet the holding period requirements, it's taxed as capital gains, and the company does not get a wage deduction. Okay, so there's symmetry between employee and employer side. It's either taxed as a compensation sort of item, or it's taxed as something other than compensation. Okay. The trick with ISOs is you don't know if Cindy's going to meet the holding period requirements, right? Only Cindy knows, and even then she might change her mind every day, right? And so until there's a sale of the shares when you don't meet the holding period requirements, you're not really assured of what the tax consequences are, right? So ISOs are a bit of a wait-and-see exercise. If you get an ISO, if you're granted an ISO by a company, you're capable of getting that good tax answer, but you're never sure. Okay? So that's ISOs in a nutshell. Questions on that? How do you know when the individual sold that? That's a good question. So most big companies keep their stock compensation through a standard broker that every employee uses, and so they can grab the data that way. But it's entirely possible that you could, let's say that your company had a Merrill Lynch account and you exercised your option, the share of stock goes into Merrill Lynch, and then say you didn't like Merrill Lynch, so you wanted to transfer it to, Goldman Sachs or something like that. So you could transfer the share out, the company could no longer see it, and you'd have to tell them if you exercised or sold the shares. So it would have to be self-reported by employees. That problem is cured by the fact that most people don't grant ISOs. But as you can imagine, that's a problem. Okay. Any other questions on ISOs? Okay. If you're a small company, okay, you're VC funded, your stock's like 8 cents, you're hoping to make it big, ISOs make a lot of sense because you might meet the holding period requirements. You might exercise today because it doesn't cost you anything to buy the stock, right? You're not going to lose money if you paid 8 cents. Otherwise, you might lose 8 cents, right? But you're hoping the stock goes to like $100. So the upside is a little different with that kind of company than it is with an Oracle, right? The other thing is if you're going to pick up AMT on exercise, well, that AMT is going to be 8 cents, right? Or it's going to be some small number because you're going to do all these steps when the company's value is low. So sometimes you hear about ISOs when they're small growth companies. And for those, it does make sense. But for the bigger, mature companies, any company that's publicly traded, you'll rarely see ISOs. Okay. Oftentimes, big companies acquire small companies, and the big companies inherit those ISOs. So that's, if Oracle, and they like to buy up lots of companies, they buy up a company and it has ISOs. Oracle may not itself issue ISOs, and I don't know, but maybe it doesn't, probably doesn't. But it would be very likely that it bought companies inherited ISO programs from those targets. That's typical. Okay, a non-qualified option is easier. Okay, so let's keep using our Cindy example. I don't have to call on you tonight. I can just pick on you. So let's say that the company goes to Cindy and says, all right, if you work here a year, you can acquire our stock for $25. And a year passes by, the stock is 26. Cindy says, I would like a share of stock for 25, so here's my $25. Oracle gives her a share of stock that's worth 26. So now, it doesn't matter what she does. She could hold, she could sell, she could throw it in the garbage, it doesn't matter. She's taxed on $1 as wage income. Okay, so even though she hasn't sold the stock and doesn't have the cash from the sale, she's taxed on the $1. Okay, it shows up in her W-2, it's subject to withholding, it's treated just like wage income. So this one's easy. Problem is all that gain is taxed at ordinary rates, right? So there's no tax advantage per se to having an NSO. It's just like a bonus. The tax is triggered when the employee exercises. So an employee can wait and wait and wait and wait and don't exercise until they're ready to pick up the income or to sell the shares. And that's a common thing to do. But otherwise, this stuff is taxed at ordinary rates, ordinary income, no tax advantage. Okay? So as you can imagine, or hopefully you can anticipate that the next comment is, if Cindy picks that up as W-2 income, as wage income, then the company gets a deduction, right? So if Cindy works for a company where the stock went from 25 to like 325, then she has huge income, the company has a huge deduction, right? So if you think of the big companies out there where the stock has gone nuts, they have a lot of people that got huge income, drive nice cars, but then they also have huge deductions, right? And so I'm sure you always think about the employee side of things because that's easy to be like, I want to be like that person, right? But if you put yourself in the company's shoes, those companies are getting large deductions too. Okay? All right, ISOs versus NSOs. How are we doing on that? Okay? Okay, ISOs versus ESPPs. Okay, an ESPP is an employee stock purchase plan. So the accounting rules have changed on ESPPs and have made it harder for companies to maintain ESPP programs. So you see kind of less and less of these. But the way ESPPs are generally, the way they generally operate is ESPPs are meant for like the mainstream, right? So say you guys are all a bunch of like blue collar workers and the company wants to give you some equity and it's trying to throw you a bone, right? It wants to give you some equity like in the money at a discount. The way that ESPPs work is it basically says if you have a program on a non-discriminatory basis, meaning everyone can participate, and you say to people, look, you guys can all set aside up to 25 grand a year, and you can buy the company stock. You can buy it at a 15% discount. And you would think, man, who wouldn't do that? That sounds pretty good, right? Because you're guaranteed to make 15% on your 25 grand. And the way it would typically work is there would be a period where there would be an ESPP window. And let's say that the window is the calendar year. So let's keep using Cindy because this is fun. So let's say that their ESPP period is a calendar year. So the stock at the beginning of the year is 25 bucks, and the stock at the end of the year is 30 bucks. The way the ESPP program would typically work is they would say you take the lower of the two, and you can buy the stock for 85% of that. Okay? So Cindy could buy stock valued at 25 grand for a price equal to 85% of 25, even though the stock today is 30. Right? So that sounds pretty good. So let's say that means, so let's say Cindy says, okay, great. I set my 25 grand aside, I buy my stock. Now, the ESPP works just like ISOs, or very similar anyways. If Cindy meets holding period requirements, if she keeps holding the stock, the gains are taxed as capital, the employer doesn't get a deduction. If she decides, no way, I can't believe I made that much money just from doing nothing, and I just want my cash, and she sells the stock right away, then she picks up wage income, company gets a wage deduction. Okay? I'm kind of oversimplifying here on purpose, but I want you to see that the program is a little different. ESPP isn't an option. It's a program where you set aside money to buy stock. So even in the situation, so let's take an example where, let's compare the ISO example to the ESPP where the stock goes down. So let's say at the beginning of the year the stock is 25, at the end of the year it's 20. Okay, if she had an option to acquire shares at 25, she's probably going to say, well, that's a dumb thing to do. I mean, I could just go buy them through my broker for 20, so why would I pay Oracle directly 25, right? My option's worthless. It's underwater. So in ISO, you would do nothing with it, right? It would just lay there unexercised. But in ESPP, remember, she's buying the stock at 85% of the lower of 20 or 25. So she's going to be able to pay $17 for a share of stock that's worth 20. So the economics are different, right? And so it's kind of a you can't lose with an ESPP unless you hold the shares and the stock keeps going down. Okay, but whether you hold the shares after that period's over, that's up to you. That's not part of the program. Okay? But think that ESPPs and ISOs are similar. They're both statutory awards. ESPPs, I think, are in 423, I think. And both allow you, as an employee, to get favorable capital gains treatment and, kind of parallel line of thought, the company wouldn't get a deduction as long as you're benefiting from that lower tax rate regime. Okay, so that's ESPP. Okay, so we've already covered disqualifying disposition of ISOs. A disqualifying disposition is just when you sell and you haven't met the holding period requirements. There's comments in the slides about things like when it's in the W-2, when it's subject to withholding. I'm going to kind of gloss over that for now. All I want you to understand from this is when is it taxed as ordinary income, and therefore when do we get a deduction as a company? When is it not taxed as ordinary income, and therefore when do we not get a deduction? Those are the key themes that you've got to pick up on. Okay. So that's your 15 minutes on options. So I'm going to stop talking about options, and so if you have a question about options, now would be a great time to ask. Cindy, do you get options or RSUs? Or none? You get ESPP. Okay. Koi, what do you get? You get RSUs probably? And non-quals? Both, huh?
Well, non-qual was the online, and then RSUs, what they did.
Right, okay. All right, so we'll talk, when we hit a breaking point, we'll talk a little bit about why companies issue one versus the other and kind of what's their motive. Because there are cash considerations, dilution issues, the book accounting differs. There's a number of considerations that companies go through in terms of why they give what awards to different people. And then there's also kind of the whole pay for pulse thing versus pay for performance. Like, that's an interesting debate amongst people, whether you should be giving people awards for, whether you should give them value just for existing and being alive at work, or whether you should compensate them when the stock goes up. Because different awards kind of achieve certain different goals that way. Okay, so the pay for pulse term, that just means if you just keep working there and you're alive, then you get stuff, right? And so that's a good segue into the next thing we're going to talk about. Okay, so with NSOs and ISOs, remember how I said that if the stock went from 25 in our example down to 20, you wouldn't even do anything with ISOs, right? In Silicon Valley, what happens is people go find another job and they try again, right? And they hope the stock at the next company goes up. Okay, so now we're going to talk about RSUs and RSAs. Okay, so we're going to start with RSAs. So an RSA is a restricted stock award. And what a restricted stock award basically is Oracle gives to Cindy a share of stock and says, here's your share. Okay, it's worth 25 bucks. Now, you hold the share, it's in your account, but if you quit, we're taking it back. Okay? So there's a risk of forfeiture. That means that that share isn't really Cindy's, right? She's holding on to it. If there's a dividend, she gets the dividend most likely. If there's a vote, she gets the vote. So she has the kind of indicators of a stock ownership, but yet it's not really hers, right? She can't keep it unless she meets those vesting requirements. And so, the way restricted stock works is it's taxed to you on vest. Okay, so even though on day one the company says, here, Cindy, here's your share, but you got to work here for a year, or else if you quit, we're taking your share back. A year later, when she vests and she says, it's my share, nobody can take it back anymore, the value of the share then, at the date it vests, that's taxable to Cindy. Okay? So in our example where they granted a share of stock to her when it was 25, a year later the stock is 26, a year later when it is 26, the vesting requirements are met, then $1 goes in her W-2. Okay? And that income is subject to withholding. Works just like wage income. It's exactly the same as NSOs. Employee gets W-2 income. Company gets a deduction. Cindy's basis in the stock is now 26 bucks. right? Because she picked up 26 of income, so the basis in her shares are 26. Okay. So the thing you can do with restricted stock is Cindy could say, man, I think the stock is going way up. Okay, so I'm happy to get that share of stock, but I don't want to be taxed in the future. I want to be taxed now because I think in the future, if the stock goes to 45 bucks, I want that gain taxed at cap gain rates, not at ordinary income rates. So she could make an 83B election, which basically is a piece of paper you file with the IRS that says, look, I just got this share. It's not substantially vested, but I want you, IRS, to tax me on it now. I want to treat myself as owning it outright for tax purposes. So tax me on the 25 bucks. I got my value. I'll happily pay tax on the 25. But then a year later, when the stock is 45, that extra 20, it's taxed as capital gains. Okay? And so if you were a believer that the stock's going up and you wanted to play that tax rate arbitrage game on that extra profit you were sure was coming, then you can make an 83B election. Okay. If she makes the 83B election when the stock is 25 and the stock goes to 0, well, that's not good, right? Because now her basis in the stock is 25, she has a capital loss. The capital loss isn't going to offset that wage income you picked up, so you're screwed, right? You picked up $25 of income and you don't have any cash. Okay, so an 83B election is risky if the stock goes down. So again, just like with ISOs, an 83B election works great when the stock is 8 cents, right? Doesn't work great when it's Google, right? Stock's $1,000, so you make an 83B election on one share of their stock, you're picking up a lot of income. Okay, Ming, or Wei. Okay, so what's the difference between restricted stock and non-qualified options? Okay, so this is back to the pay for pulse thing. Okay, so let's say that every year the company gives Cindy a share of restricted stock, and the stock stays at 25 bucks every year. And every year, year in, year out, they give her one share, and the next year she vests. They give her another share, and the next year it vests. The stock stays at 25 for forever. So every year she's picking up 25 of income, right? Because she's getting a share of stock worth 25. The stock's not even going anywhere. So she's getting compensated when the stock price isn't even moving. If the company gave her an option that said, hey, you can buy from us a share of stock for 25 bucks, if the stock doesn't go anywhere, well, then that thing doesn't really mean anything to her. So economically, you're making money with restricted stock if nothing happens. But economically, with an option, you're only making money if the stock goes up, right? An option is like a bet on the future. Okay, whereas restricted stock, sure, you make money if the stock goes up, but you also make money if the stock goes down, right? Stock craters and falls in half. You're still making money. It's just half the money that you were hoping to make. Okay? And so if you put yourself in a boardroom or kind of in an annual meeting with shareholders, you could probably envision kind of what the debate is in terms of how they should compensate people, right? Okay, so that's restricted stock. So most companies do not grant restricted stock, and the reason is that example where somebody would make an 83B and then the stock would go down and the employee would be screwed. And so the company, it doesn't take many of these cases where an employee goes to a company and says, you didn't tell me this could really screw me, and now I'm in a ton of trouble and I hate you, and how are we going to become friends again, right? HR doesn't want to have that conversation. I'm sure they disclosed, or at least meant to disclose, kind of what the consequences are, but this stuff is complicated. And if you're a non-finance, non-tax type person, you hear all this mumbo-jumbo, and you tend to hear the good stuff and not the bad. So companies would think, well, we would just be better off if we didn't give restricted stock, because that way people can't even make these 83Bs. The problem will go away. Okay, so instead, companies started granting what are called RSUs, or restricted stock units. Okay, so here's what a restricted stock unit is. So instead of saying, here's Cindy, here's the share of stock, I'm going to yank it from you if you quit, a restricted stock unit is exactly the same economics, well, very close economics, but instead of giving you the share now, we're going to promise to give you the share in a year. Okay? So it's not an option. We're just saying today, if you work here in a year, we're going to give you a share. Okay? And you know what the shares were today. And it's really one of those like 6 of one thing, half dozen of another, right? Instead of giving you the share and potentially taking it away, we're just not going to give you the share yet, and when you vest, we'll give you the share. So it's similar, right? You work for a year, you get a share, both ways. Stock goes up, you make the same amount of money. Stock goes down, you make the same amount of money between RSAs and RSUs. But it's cleaner because you can't, as an employee, make an 83B election on what amounts to a promise to get a share in a year. 83B elections can only be made on property, and a promise for a company to give you a share is not property, it's a promise. Okay? So RSUs are kind of a nice way of sidestepping that 83B issue. And even though 83B was meant to be a good thing for people, it's kind of a headache for companies. And so in order to kind of put a lid on that headache, they just say, well, we'll just grant RSUs. So, company gives Cindy an RSU, and they say, in a year, we'll give you a share. The stock is worth 25 today. A year goes by, the stock is worth 26. When that year period lapses, she gets a share of stock. She gets 26 bucks in her W-2, subject to withholding. Company gets a deduction for 26 bucks. Works just like an RSA. Works exactly the same. Just forget about the 83B mechanics. Okay? So whatever the employee is picking up as income, the employer picks up a deduction. What happens after the vesting is up to the employee. They can sell the next day, they can wait and hold it for 100 years, they can throw in the garbage, it doesn't matter. The W-2 and the employer consequences are all determined on that vest date. Okay, so that is NSOs, ISOs, ESPPs, RSAs, and RSUs. Okay, how do you feel about that?
Just want to make sure that, is it correct that when you exercise the non-qualified stock option,
Just payroll taxes when you exercise a non-qualified option. Yeah, that's right.
and for disqualifying disposition,
There's no FICA taxes on ISO disqualifying dispositions. That's right. Okay, so now we're going to get into tax accounting. But before we do, let's just talk for a minute about why companies issue options versus RSUs. Okay? So remember how we kind of explained that the economics are different for Cindy, whether she gets an option where she's only making money if the stock goes up, or an RSU or RSA where all she's got to do is stay alive, right? And keep working there. So that means that the value of those awards are different, right? The economics are different. So if a company went to you and said, here's a share of stock, it's worth 25 today, you just got to work here for a year. Like, what's that worth? What is the value of that? What would you pay for that? Joyce, what would you pay for that? $25. It's not a trick question, right? It seems like the right amount to pay, right? Everyone knows what the stock is worth. It's publicly traded. They're saying they're going to give it to you. It's today's value. You just got to work there a year and then you get it. Okay, so let's say that Oracle gave you instead an option to say, okay, in a year you can buy our stock for 25 bucks. Okay? So Sam, how much are you going to pay for that? Forget you're an employee. If you're just an investor and Oracle just like saw you on the street and they're like, hey, we'll give you an option to buy our stock for 25 bucks in a year, how much would you pay for that? Think of it like it's a baseball ticket. Some guy's trying to pitch it to you. Yeah. You would pay 25 bucks for that. I will sell you that instantly now. Okay, Eugene, how much would you pay for that? $1. Eugene is not a believer in your company, Cindy. Okay, Joe, how much would you pay for that? How much would you pay for the right to buy Oracle stock in a year for today's price? For free? That is one of the problems, actually. Is a lot of employees think that it's worthless. It has value, right? You don't know what's going to happen. Let's say that the company does great, and then in a year the stock's 35 bucks, right? So there's that possibility that you're about to make a ton of money by being able to lock in today's price, right? It's almost like how when you play around with mortgages, right? Do you want a fixed mortgage? Do you want like a 5-year? You're betting on like the speculative aspect of what will happen in the future. In that case, it's on interest rates. In this case, it's on the stock price of Oracle. But there's some value, right? And for big public companies, they trade options in the public market. You can find out what a certain option with specific terms is worth. But based on the volatility of a stock and kind of the volume involved with trading on a company's securities, options have value because they have that speculative value. So somebody might say, look, I'll pay 10 bucks today for the right to buy Oracle stock next year at today's price. And you think, man, that person's like pretty optimistic that they're going to make at least, the stock's going to go at least up 10 bucks, right? Because otherwise, why would they do it? And so the trick is to figure out what that value is. Okay? So from a company's perspective, the reason that's important is when Oracle gives Cindy equity compensation, they have to expense it for GAAP purposes. Okay? And when they give her a share of when they give her an RSU, they expense 25 bucks. They know what it is. It's predictable, right? It's very objective. When they give her an option, they have to expense the fair value of the option. Okay? So they would prefer to use Joe's approach and say, well, that thing wasn't worth anything, right? But more realistically, they have to use my approach and say, well, there's some fair value of that option, right? Whether it's 10 bucks or 6 bucks or whatever, and then they have to expense that. So even though Cindy may not make $1, like let's say the stock just stays at 25 bucks. So Cindy doesn't make any money. She's like, that's stupid stock, right? I knew I should have worked for a different company. You know, she's like, I'm looking at Google, the stock's going up, right? Ugh. And she'll think, that thing was worthless to me. I don't even know why they bothered, right? But that's only because it didn't go up, right? You would feel completely differently if the stock went from 25 to 50. You're like, I'm pretty happy with those guys for giving me that stock option, right? So an employee, only with the benefit of hindsight, can really feel value in these things. But if you were, you know, if you put your finance hat on, right, and you thought, gosh, what is the fair value of this financial instrument? It has value even before you're able to cash it in, right? So a lot of times companies will be granting those options. They'll expense, let's call it 6 in my example. They'll expense 6. The stock will stay at 25. She won't exercise, but yet the company will have to expense 6. And they'll say, man, this is a bummer, right? We're expensing amounts in our income statement. You know, Cindy's not happy. We're not happy. Like, nobody's happy. This is not good, right? So it's a downer for the company because their earnings are down, right? Cindy didn't actually feel like the company gave her anything, so she's not happy. And so a lot of times companies are like, well, this is not good. We want to make at least somebody happy, so we can move to an RSU model. And at least with RSUs, Cindy gets something, right? If the stock stays at 25, she gets 25. The company expense 25, and they'll think, hey, at least what we expense, Cindy feels good about, right? So there's parity. And so in a lot of ways, there's really, at least in my mind, I'm no expert on this, but there's 2 reasons why companies grant RSUs and not options. One is they hate having to expense a number that people think is either in excess of fair value or doesn't actually correlate with a benefit to the employee or a perceived benefit to the employee. Right? And so expensing those large option amounts for book purposes, it just looks unattractive. And the second thing is with RSUs, there's no guessing what the value is. You just know it's the value of the stock, right? So companies can model it, they can forecast it, they can anticipate it. It's just much easier. So you're not relying on some economic model to tell you the value of your equity, even though it seems like this very hypothetical thing. All right, because if your stock went up and down and all sorts of crazy, the way the models work is it's going to come back and say an option's worth a lot of money. Because the bigger the volatility is, the more speculative value is in an option. And so if a company grants an award that relates to a volatile stock, that award will look expensive. Cindy's still going to be like, well, I don't care. I only care if the stock goes up. And so the company's kind of the divide between how the employee feels and the employer feels, right, that gets bigger the more volatile your shares are. But with an RSU, it's just very straight, right? It's very simple. The problem with the RSUs is you're back in a pay-for-pulse model, right? So if what you're really trying to say to your employees is grow the company, make the stock go up, and we'll only pay you if that happens, that's an option model, right? And so it's really a balancing of all those dynamics in terms of where people come out. But the heavy trend is for people to go to RSUs, for sure. Okay, so now we're going to get into tax accounting. That's equity awards in a nutshell. It's like 45 minutes on equity awards. Okay, so from here on out in class, I'm going to assume you understood everything I said and you're totally cool with that. All right? Okay, tax accounting for restricted stock and RSUs. All right, so for whatever reason, this content always blows people's minds. And I will try to make it as simple as possible. But now we're going to get into the part where your faces will be like, what? Right? Okay. So we're going to start with restricted stock and RSUs, right? RSUs are the most common types of equity awards. So let's just start with where the biggest volume is. So book expense. Like in my example with Cindy, they give her an RSU, the stock's 25, book's expense is 25, they expense it over the vesting period. So if the vesting period is a year, they expense 25 in a year. If the vesting period is 5 years, they expense 5 a year. Okay? The tax accounting. Okay, so the way the tax accounting works is if the company grants her an award and says, here's a share or an RSU for a share when the stock is 25 bucks. In a year, you expect to get a deduction as a company, right? It's an RSU. You know, just by way of the structure of the award, you're going to get a deduction, right? This thing is taxed like wage income. And so, books is expensing it now, tax will deduct it later, right? What does that sound like? Temporary difference, right? Okay, so this is a temporary difference. So if they give Cindy the award, it's 25 bucks, they start expensing it, we can't deduct it yet. So we add back that expense, just like it's bad debt reserve, right? So we set up a DTA, and that DTA is going to be for how much? That's right, 25 bucks. So you use the book value as your proxy for what the future deduction is going to be. Okay? What if the stock went from 25 to like 1? How much is your DTA? 25, that's right. So you use, until there's a settlement, you use the book value as your reference point for the future deduction. Okay? So ideally, books expenses an award is 25 bucks. You set up a DTA because you can't deduct it. Then you vest, the stock's still 25 bucks. So you just reverse the DTA and you reduce the payable. Just like every other temp difference we've ever talked about. Okay? The trick is what happens when the stock vests, or the RSU vests, and you get a share of stock, but it's not worth 25 bucks. Not so much. So we'll talk about that in a minute. Okay? For now, I want you to have in your head, when books expenses it, we can't deduct it. But we know we're going to get a deduction in the future, so we treat it like a temp item. Right? This is like bad debt reserve. We can't deduct bad debt reserve now, but when we write off that receivable, we'll deduct it. We can't deduct that book expense for the RSU, but we can deduct it when the RSU vests. Okay? It's timing difference. We good with that? Okay. The same thing is true for NSOs. So you can see on this slide, tax accounting is similar to NSOs. So if Cindy got an award where they said, all right, here's an option. So let's keep using my example where we said the value of the option was $6. Okay? So I say, Cindy, here's an award. You can acquire our stock for $25 in a year if you're still working here. She's like, great. I put zero value in that, but let's just see what happens in a year. Okay? So a year goes by. The company expensed $6. Okay? When she exercises an NSO, the company gets a deduction. So that means that we assume that our deduction in the future will be 6. And you guys didn't do the reading. So you use the book value in the RSU case and the option case as the proxy for your future deduction. Okay? So Cindy's like, I don't know if I'm making $6, but it doesn't matter. Book said you're going to make $6, or that's the fair value of the award, so we're going to anticipate that as our future deduction. That's the rule. Okay? So as books expenses to 6, we can't deduct it, but when we know in the future when there's an exercise, we're going to get a deduction. So for now, we assume the deduction will be 6. Okay? So we set up our DTA, and then we wait to see what happens. Okay? How are we feeling about that? Okay, so we're going to go through this in way more detail in a second. Keep in mind, temp difference. If it's an NSO, if it's an RSU, RSA, temp difference. Books expenses it, we get a deduction later. Okay? We're going to figure out in a minute what happens when the stock changes value and it's either higher or lower. Okay, if we get a restricted stock, and so let's say Cindy gets a share of stock and they say, okay, here's the share. You don't get to keep it unless you stay working here for a year. Cindy says, this stock's going up. I'm making it an 83B election. Okay? So on day one, she picks up 25 of income. Company picks up a $25 deduction. So the company's picked up a deduction before anything happens, right? The first day, the company picked up a deduction. For the next year, the company is going to expense the $25. So here, with an 83B election, our deduction actually precedes the book expense. So it's the flip of the temporary difference we just talked about. So remember with the RSUs a second ago, we said books is going to expense the 25, and then after a year, Cindy gets the share. Here, with an 83B, Cindy says, I want to be taxed today, then books will expense the award over the vesting period. So it's the exact opposite timing. Okay? So we get the deduction right away. Books expense follows. Okay? So here you can see that in this little section down here, since the deduction is a grant and the book expense is over the vesting period, this actually results in the DTL, which reverses over the period that the book expense happens. Okay, so on day one, you get a deduction. You're going to debit your payable for 25. You're going to credit your DTL for 25. Okay, debit payable, credit DTL. And then as that book expense is recognized, it's not deductible. You already deducted the award, right? So let me kind of write this out here. So on day one, you're going to debit your payable for 25. and you're going to credit your DTL for 25. Okay. Day 2, books is going to expense 20. Let's just assume it's 100% tax rate. Books is going to expense 25 as comp expense, and that's their debit. Their credit will be equity, so that's the pre-tax entry. And then the tax expense, again, just assume 100% tax rate, is going to be debit DTL, credit provision. Okay? And now the provision benefit you book for this expense will be recognized in the same period. They'll be matching. Okay? If you're going into like overload, the thing I would forget, like the person I would throw off the boat, is the 83B part. That's not the most important part here. Okay. Overview here. Okay, let's get the main themes right. For most awards, when you recognize book expense, you're going to book a tax benefit. The reason you're going to book a tax benefit is because you're going to anticipate a deduction in the future. So if an employee gets an NSO, RSU, RSA, all those things are going to result in future deductions. So that means when books expenses the awards, we're going to say that's just a timing difference, and in the future we're going to get a deduction, so we'll set up a DTA. Okay? To the extent that we get an award that's an ISO, we're not sure if we're going to get a deduction, right? It depends. Same as with an ESPP. We don't know. It depends on whether the employee meets the holding period requirements. So for those types of awards, we don't anticipate a tax benefit. We don't set up a DTA. We don't treat it as a timing difference because we don't know. I mean, the dumb thing about ISOs is it's like 10 out of 10 times when somebody gets an ISO, they fail the holding period requirements. So you might say, well, as a practical matter, people are going to give me, they're going to have disqualifying dispositions, so I should just anticipate it. But that's not how the rule works. The rule says if by statute you're not sure if you're going to get a deduction, don't anticipate a deduction. Okay? So for ISOs, we don't set up a DTA. Same with these ESPPs. We wait and see what happens later. Okay? We'll get to that in a second. Okay, so basic concept number 1. For most awards, NSOs, RSUs, RSAs, we book a tax benefit, we book a DTA when there's book expense. Okay, the next thing we do is the time passes and there's some kind of settlement. There's either vesting or there's an exercise of an option. Something happens where we realize our tax consequences. And we got to figure out how much was the actual tax effect compared to what the book expense was, because there's going to be a difference. If the tax savings are greater, okay, so let's say that the stock goes from 25 to 26. You only set up a DTA for 25, but when the deduction for 26 comes, you got to figure out how to book a journal entry, right? Okay, so let's take this guy right here. So on day 1, you debited DTA for 25, you credited provision for 25. Then the stock goes to 26, you vest, there's a $26 deduction. Okay? So you got a debit payable for 26, credit your DTA for 25, because that's all you had, and you credit APIC 1. Okay? That's how that works. So if you remember in the NetApp 10K when Lee was here, they had all those credits to APIC. It's lots of ones. Okay? That's what that is. Okay. By contrast, if the stock goes down, let's say the stock went from 25 to 24. Okay, you still set up a DTA for 25 in year 1 because You don't know what's going to happen. Now you're going to debit your payable 24. You still have to reverse your DTA of 25. You got to get rid of it because the award's gone. Right? So now you got to debit something for 1 to balance your entry. And the question is, what do you debit? Okay, the short answer is you debit APIC unless you don't have an APIC pool. Okay? And an APIC pool is basically the sum of all the credits to APIC you booked. You build up a pool of credits. And in the future, if your stock goes down and you have these shortfalls, you can use those credits and say, yeah, well, I'm going to debit APIC in this example for 1. But if your stock goes down and down and down, and you run out of APIC credits, your piggy bank goes dry of APIC credits, then you have to start hitting provision. Okay? So if you're a company that has no APIC pool, that debit is to provision. All right. Questions on that? Okay, so we're going to slow down a little bit, and we're going to go through that all again. First thing we do, we got to figure out what kind of award we have. Do we have an award that we're going to anticipate a deduction for or not? So if you see NSOs, RSUs, or RSAs, we're going to anticipate a deduction. And so we are going to be debiting a DTA. Yeesh. We're going to be debiting our DTA and crediting our provision. Okay. So next thing we're going to do is we're going to figure out what happened to the stock. Right? Did the stock go up? Did the stock go down? And we've got to compare our payable versus our DTA. They're going to be different. We set up a DTA anticipating a deduction, but then when the payable effect comes in, it's going to be different. We got to do a comparison. If the savings are greater, then this is what's called a windfall, or an excess benefit. Okay, if they're greater, we're going to debit our payable. I'm going to keep using that example so you're familiar with the numbers. We're going to debit our payable 26. We're going to reverse the DTA that we booked in anticipation of a deduction. And we're going to credit APIC for 1. These are for RSAs, RSUs, and NSOs. Okay. If the stock goes down, we're going to debit our payable for 24. We have to credit our DTA for 25 because we got to get rid of it, which means we need to debit something for the 1 to balance the entry. Okay. And if you can, you want to debit APIC, because no one ever wants to debit provision for anything, right? That's no fun. So Cindy, you know how big your APIC pool is? Wait, you know how big your APIC pool is? That was the perfect answer. There's two kinds of companies. There's companies who have enough, meaning it's so big they have no idea. And then there's companies that have none. I'm serious. Oracle, they have so much that, just like everything with Oracle, right? It's just probably out of this world. And so, if you ask Google what's their APIC pool, they're like, I probably don't know. I don't know. Maybe they're tracking it, but it's so big, right? Because the stock just keeps going up and up and up. So there's more credits to APIC and more credits to APIC. You know, we had Amazon as our 10K. If you got a stock chart of Amazon out and looked at the stock price over the last half a dozen years, it's just, that company will have a giant APIC pool, right? Because their stock just goes up. If you look at a company whose stock has just gone down and down and down, they're not going to have an APIC pool. And so, in this situation, as they have shortfalls, they're going to have to write that off to provision. Okay. But yeah, when these rules first came out, all these companies were scrambling to calculate what their APIC pool was. But then, boy, you rarely hear about that because you fall into one of those two buckets, and then you either don't worry about it or it's a daily problem. Okay.
So if the APIC pool has a limited amount and you dip into it and then you used all the APIC pool, then you end up taking it to provision, right?
Mm-hmm. Think of it like a vacation account. You know, you earn vacation, you go take vacation. Once you take too much, you stop getting paid. Right? It's kind of how an APIC pool works. Okay, a few more pages, and then we're going to do some exercises. I don't like this class. I got to talk so much. Okay, so non-statutory awards. On the left side is options. The right side is stock. Do we get a future employer deduction? Yes. How is the deduction determined? For options, it's the built-in gain on exercise. For awards, it's the value, less than the amount paid, but usually the amount paid is nothing. It's the value when the restrictions lapse. Do we recognize the DTA for the book expense? In both cases, yes. Okay. Okay, our example number one. Company A grants a non-qualified option. The stock is worth $30, and it, no, I guess this isn't the stock that's worth $30. This is the value of the award. Okay? The value of the award is 30. The stock price, as you can see in the next bullet, is 40. So somebody basically saying, I think this stock is going up at least $30 by the time the period of this option expires. Okay, so usually options are 10 years in term. So if somebody said, hey, anytime in the next 10 years you can buy our stock for $40, if you said, how much is that worth to you? In this example, it's worth $30. So $30 is the speculative value of what this thing might be worth based upon what might happen to the stock price. And strike price. A strike price means what do you have to pay to get the share? Okay, so in our example, it's $40. It's today's stock price. Okay. So we assume that the stock goes to 80, and then we want to figure out, well, what do we do? Okay, so what are the journal entries for 07 and 08? Okay, you can see how old these slides are. So what is the journal entry for 07? Books is going to expense 30, right? The value of the award is 30. Books expense is the value. Okay, so there's 30 of expense in our PBT. So what is our tax entry in year one? Ziad, what's our tax entry in year one? Oh, you're off the hook for a second. Right. You'll debit DTA for 12. You'll credit provision for 12. Right, there's no impact to the payable because we don't get a deduction currently. So this is nice from a P&L perspective because when the books expense 30, there's a 12 tax provision benefit. It looks like a deductible expense. Right? It's not currently deductible, but there's a rate benefit on that expense. So the net income for year one is 18, even though they had a 30 expense that was temporarily non-deductible. Okay? So in year two, the stock is worth 80. The person pays $40 for the shares and has a $40 gain. $40 gain means that there's a $40 deduction to the company. So we show the solution here in two entries. The first is to remove the DTA. Right, we've removed the DTA we set up in year one. We reduce our payable by 16, the deduction. These provisions wash out. And so APIC is our excess. Okay, questions on that? You good? The 40 is the gain, that's right. There's two 40s. In fact, we should change this problem like the next slides. I want to use the same number for two different purposes. So the 40 is both the strike price and then there's also a $40 gain because the stock doubled in price to 80. Should make the stock price like 75 or something like that. Okay, fact number 2. Company grants a non-qualified option. The value of the option is 25 bucks. The value of the option. Stock is worth $40 today. When the exercise happens, it's worth 50. Okay, so Ziad, what do we do in year one or in 2007? What is the journal entry that we book? You're looking ahead, man. You can never trust a guy with a Z name, huh? I was actually hanging out with your boss's boss yesterday, so I'm gonna rat you out next time. I was hanging out with Rich Johnson. We were comparing haircuts. It's good. His is definitely a little tighter than mine. Okay, so good answer. In year one, we're going to set up a DTA for 45% of the book expense. Right? Books expense 25. They said that's the value. That's what we're going to expense. Tax is saying this is the kind of award we can anticipate a deduction for. So I'm going to set up a DTA, anticipating that deduction for the same value, which is my book value. So I set up a DTA in 2007 of 10, which is 40% of 25. And I book a provision benefit to match the book expense of 25. Timing difference, right? Imagine this was bad debt reserve. You'd do the same thing. Right? Don't let the stock comp thing mess with your head. Okay, so in year two, stock is 50 bucks. The person exercises, they get a $10 deduction. The company does. Okay? So they get a deduction of 10. Okay, so they got to get rid of the DTA. Man, we did it again. We used the same number for two different reasons. We got to get rid of the 10 DTA we set up in year 1. We were anticipating 10 of tax benefit, but then we only got 4 of tax benefit. That 4 is our deduction of 10 times our tax rate of 40%. That's amazing. Both examples we did so stupid like that. Okay, so we thought we were going to get a deduction of 10. We had a DTA set up. We got to get rid of that DTA. We only got a tax payable benefit of 4. And now we got to figure out what we can do to balance the entry. Okay? And here the assumption is we assume we have sufficient APIC pool. So because of that, we book the debit, the balancing debit to APIC. Okay. In the previous example, how come we didn't get rid of the DTA? We definitely got rid of the DTA. So in the previous example, we set up a DTA of 12, 30 of book expense times 40%. And then upon exercise, we reverse the 12 in that first entry. We always got to get rid of the DTA, right? There's not going to be any more deduction. Once we get our deduction, we're done. Okay. Wait. Wait, you have to talk louder. Sorry. I can't hear you. Okay, what if the stock is $20 and you don't want to exercise the option? Okay, so you don't exercise the option, then what happens? So is your question what happens if I never exercise the option? Right, so in that case, the stock is worth 0, right? Or the value of the award is worth 0. There's not going to be a deduction. So you have a DTA set up, but you never have a payable. So you have a shortfall for the entire value of the DTA in that case. So if the option expires, because the stock never went above the option price, and so there was no reason to exercise it, that DTA you set up, that has to be written off, and it'll be written off when it expires, either to APIC if you have a pool, or provision if you don't. It's just like having a deduction when the stock went down. It just happens to be that the stock is now 0. So one of my clients had no APIC pool, and they had a ton of options like that who were out of the money. And they're like, this isn't good. We got all these DTAs set up. Our stock is down. We have no APIC pool. We can anticipate we're going to be just debiting the provision over and over again. This is not good. That company ended up getting acquired, but take them out of their misery. But yeah, they had a really ugly situation. Okay. So as much as I had fun just talking for an hour and a half, now you guys get to do problems. Okay, so this is our first problem. Let me flip to it. Okay, we have a company that has income. They have a meals and entertainment perm. Got a bad debt temp. They got non-qualified options. Okay, so let me explain this because this is a little confusing. There's 2 sections here. The first section, hate using PDFs. Okay, so the first one is this guy. Current year, non-qualified book expense of $165 grand. Okay, that means in the year, books expense 165, we can't deduct it because the person that got the award didn't exercise yet. Okay, that's what that means. Got it? The second set of information, which is 2 rows, somebody exercises a different award, a second award. The deduction they get is 35 grand, or the company gets a $35,000 deduction for it. But previously, the company had expensed, and the company had set up a DTA for 50. Okay, so you already have a DTA sitting in your balances of 50 because you had anticipated getting a 50 deduction based on the book value. But now this year, that person exercised and the deduction is only 35. So now you're on the backside of a timing difference, right? You anticipated a deduction last year, you're getting the deduction this year, you got to flip your temp difference. We had an NOL last year, meaning we had a DTA coming into this year for an NOL we had last year. Our tax rate's 40%, and assume we work with Kuwait and we have so much APIC pool we don't even care. All right, off you go. I'm going to give you about 15 minutes to try to figure it out, so work fast.